Hey there, Jeff Lewis here from Epic Trust Investment Advisors. Just wanted to reach out and say hello to everybody that we're working with, and also wanted to just give you a quick market update on what we're seeing from the market right now, and just give you a quick recap on what we saw for this last month, as well as try and give you some perspective on what we see this really turning out to look like. And what I'd like to do is primarily answer the question of whether or not this is the next big correction and the next big recession, or if this is just going to be a short-term market downswing, a nice little correction that we need to have on a semi-annual basis, or if this is going to be a longer-term or shorter-term issue. So anyway, I'm not used to doing a whole lot of these, so you'll have to bear with me as we get through this first couple of videos, but I'm going to try and do these videos on a more regular basis so that we can just be in front of you guys and let you know what's going on and give you our take on where things are, and most importantly, to let you know that we've got it under control, that we're watching what's going on in the market, and we haven't fallen asleep at the wheel. So with that, I'm going to jump into where we are for the market and where we've been for this last month. All right, so this is where we ended up for the month. This is the S&P 500. This is just a chart in Yahoo Finance. And what we're seeing here is that at the beginning of October, we started the month at around 29.26 on the S&P 500, and we ended the month down about 7.3%. And at its very worst on Monday of this week, we were down almost 10% for the month. So that was a really big swing. We've had quite a ride this month, and as you know, and if anyone's been looking at your accounts, you know it hasn't been very fun to watch. So that's where we're at for this month. That's a really big swing for 1 month. Earlier this year, if we back out to a year-to-date number, we also experienced a pretty big swing in that same order of magnitude back in February. So we've had two of those really big swings earlier this year. But what's interesting to note is that if we add the VIX in here, and take a look at that, the VIX back in February was much, much higher than it was this go around. On the VIX, we were back at 29 earlier on in February, and at the highest that we got was 23 or 24 on the VIX, which is a pretty substantial difference, and we're now back in the below 20 range. So that's a good sign for the market. And one of the things that we get asked, or I have been asked quite a bit this month, is whether or not we're seeing the bottom. And it's hard to say whether or not this is a bottom. Only the future can tell. I cannot predict the future. But what I can say is that we're seeing signs of a pretty strong improvement in the overall market data right now. And that's where I'd like to go next. Earnings reports and what we saw, or what we have seen so far. As of last Friday, what we've seen out of the S&P 500 is this chart right here, right in the middle. You can see that so far of the companies that have reported, which we've got a little bit over halfway there, of the companies that have reported so far last Friday, 77% of those companies have beat their earnings estimates, 8% were in line with what we expected out of earnings, and only 15% have missed. This is really strong data that is important for us to look at, because that helps us understand how strong our economy is. It's just as far as how strong our companies are in our local economy here in the U.S. So one of the important things that I think that most investors ought to know, or most folks as they're planning for retirement ought to know, is that this is a very strong economy. We're still coming in strong. One thing we've noticed, though, with this quarter's earnings is that we have started to see a slight peak in earnings, but not a real strong peak, where we haven't seen a dramatic change in the overall earnings for the companies here in the U.S. Now, globally, there are some different stories there, and I'm going to start the video back up here. Globally, what we've seen is some pretty dramatic things. We've got some pretty large headwinds that are coming in front of us, and those headwinds are the Italy issues that we're seeing. I'm going to open this up just a little bit bigger. And stop sharing my screen with you here. All right, so Italy is a really big headwind that we have right now in our market. and I'm going to bring this back to a couple other time periods we can look at to see what historically these kind of issues have done in our economy. But Italy and Brexit are two European Union issues that we're facing right now that are having dramatic effects on what's going on here in the U.S., mainly because it's their debt in those countries that, or at least in Italy, it's the debt in Italy and the bond yields in Italy that are creating the issues. If Italy in the next 2 weeks can get their budget passed with the European Union, that problem will be solved, and we're going to see a bump in the market from that because we'll have renewed confidence that we have a way forward. But right now, while we have the angst of this issue going on with Italy, that's going to continue to potentially cause problems for us. Brexit is another issue. The UK has gotten to a stalemate. Just today, I think there were some updates on that. It sounds like we might have a way forward, but nothing concrete yet as far as how the UK is going to be able to officially exit the European Union. But they are working towards that, and they have a deadline to do that here relatively soon. And so I have confidence that they're going to get there. I don't think they're going to have this whole deal blow up on them and where they will remain in the European Union. I do think they'll still leave, but that's just my opinion. And so if we can get some decent movement towards making that a reality, we're going to see some improvement in the market because of that as well. And we'll see bond yields lower or improve in the international space, which will be a positive for us and for the U.S. dollar. And so the third headwind that we have coming against us is the China trade war. There's quite a bit of things going on there. It's a very dynamic issue. It is not clear-cut one way or the other on the outcomes, regardless of which direction it goes, whether or not we get things resolved with China and we can begin trading with them without the tariffs, or if the tariffs are more mild, or if the tariffs become more increased. One thing that we do know is that if we get to a point where those tariffs continue to escalate, that's going to cause more and more issues with our economy, mostly because in the long-term grand scheme of things, we will have a slowdown in our economic growth simply because prices are going to have to rise here to be able to make up for those tariffs. So there's a lot going on with that trade war with China. I don't have any idea of where it's going to go, but that could cause some serious problems with us moving forward. However, there's more problems caused by China or caused for China if they don't negotiate with us, and so that's a positive for us. It means that we kind of have a little leverage there, and I think that's why the administration is willing to be so firm in their position. So we'll see how that shakes out. But the last thing is going to be our local elections here. We have our midterm elections that are coming up in a couple of weeks. Those are all going to be completed, and we're going to have some certainty in the market. As long as the market, and this is not a political statement, just so you understand, but as long as the market doesn't move completely towards the left, where both the House and the Senate become Democratic run organizations, the market is going to see that as a positive thing. If they do, that will be, if the Democrats take both the House and the Senate, we very likely could see some upset in the market just because that would be a very dramatic change. However, we are expecting to see at least one of those organizations transition over to being more controlled by the Democrats. So we'll see what happens there. If that happens, or if they both stay Republican after the elections, then we're going to probably see a nice little run up in the market just because, once again, we'll have certainty on where we are. And so that's really most of the headwinds that we have. Now I'm going to jump to the other side of the equation and talk to you about the tailwinds that we have going for us right now. One of the big tailwinds is that we do still have a pretty strong economy. The GDP numbers just came in last week, and they came in above 3.5%, or at 3.5%, when we were expected to be far below that. So that's a really strong sign for our economy. There could be a lot of reasons as to why that happens, but we're still hearing information from the administration and from research groups that there's a high likelihood that our GDP numbers could still stay above 3%, which means we're squarely in the category of growth and we're not nearing a recession. So that's really, really good news as far as our investments go, simply because that as long as we're in growth mode, we will, while we'll still have good and bad months, we're not going to have bad years likely, just because we aren't going backwards as an economy. So that's really good news from the economic standpoint as far as GDP is concerned. Another thing is earnings. While we're seeing a slight peaking, this is a healthy recovery or a healthy pullback that we're seeing in the market if this is the end of it, or if this next month we see the end of it. So that's really good news. Another really good thing that we've got coming our way is November. We've got the holiday seasons coming up. Consumer confidence typically goes up in November, December, just because we're buying stuff for the holidays and we're spending more time worrying about the things we really care about and not worrying as much about the market. So that's good news. So that's our good news and bad news. I want you to see both sides of the equation there. We've got some good things coming. We also have some pretty serious headwinds ahead of us. And that's okay. I'm all right with both of those, and you should be too. So let me show you a couple other things as far as the market is concerned. I'd like to, at this point, tell you that we're not at risk of a recession yet. And one of the reasons for that, and we're going to be tracking jobs numbers later this week, but the biggest pre-recession indicator, and this is the earliest warning sign indicator that we typically get, is this 10-year Treasury. I'm going to share my screen with you again here. The 10-year versus the 2-year Treasury number is really an important statistic for us to be following, primarily because it has successfully predicted all of the last 5 recessions. So if you look here in 2006 to 2007, this relationship between the 2-year Treasury yield and the 10-year Treasury yield went negative, meaning that the 2-year yield became more expensive, or it paid you more to own a 2-year bond from the U.S. government than it did to own a 10-year bond from the U.S. government. And when that happens, that causes problems in our economy, because it means that companies that use short-term money, like banks and large financial institutions, large corporations, and other governments that use short-term money, it means it costs them more money to borrow and produce their, what am I looking for here? It makes them spend more money on operations. And if they have to spend more money on operations for interest costs, it means they can't spend it in other places like employees and infrastructure and technology and things like that. So this is an important number to look at, and this is why I like looking at it, is because it helps me understand where we are in the economic cycle and whether or not we have a recession in front of us, or how soon we could expect it to be in front of us. So here's 2006 and 2007. The recession didn't hit us. That gray area here, this is the recession, and that didn't hit us until 2008. So what's important to know here is that we probably have a good year to year and a half before we could be in any real issues or real credible threats of having a real recession on our hands. Right now, rates improved today on the 10-year Treasury versus the 2-year Treasury. We're up to almost 30 basis points of a difference, which is really strong. So that's positive news for anybody that's concerned about a recession. It means that we're probably not anywhere near a recession, not at least for the next 12 months. And so if we go back with this same statistic, we can see that the recession in 2001 was preceded by the earlier issue here with interest rates, where the yield curve became inverted again in 2000. That happened about 18 months ahead of the recession. And if we go back to the early 90s, once again, we've got about 18 months of a warning sign here in the late 1989 era before the recession hit in 1990. And then if we go back to the 80s, the same story. So I love this, this indicator because it just helps us see whether or not we're really close to a recession. So that's good news again for us on where we are today, because we're not there yet. We could get there quickly, but we're probably at least a year to a year and a half away at the very soonest from having a real recession. So what does that mean for our market today, and what should we be expecting this sharp big down month? This is called a candlestick, by the way. I'm going to take you to back to the S&P 500. This is a chart of the S&P 500 for the last couple of years, and this is the month of October. We started really, really strong. and we lost almost 10% in the market from top to bottom until we recovered by the end of the month. This is the last day of the month. That's a big move. Right now, we're on the rise. We were up another 1% today, which is really great. Today's the first day of November. So what do we see this looking like with this kind of volatility? And I'd like to bring you back to September 30th, 2011. This is an article that was published on September 30th, 2011. It was the worst quarter since the financial crisis of 2008. What cracks me up is the similarities between September 30th, 2011 are eerily similar, I guess, to October 31st, 2018. I'm just going to read a couple of things here. So stocks ended a dismal quarter with heavy losses on Friday as investors remain worried about the debt crisis in Europe and the outlook for global economic growth. The Dow fell 12% in that quarter. We had a couple of companies that were really far off. They just had terrible months for that quarter. But here's the real kicker. The debt crisis in Europe is all that anybody cares about, said Dan Greenhouse, chief global strategist at brokerage firm BTIG. The worst case scenario is a disintegration of the European banking sector. What's important about that is that's exactly what's going on today with Italy. Back then, in 2011, it was a Greece debt crisis. Greece was defaulting on their bonds and defaulting on their debt, and that's one of the reasons that the European Union is being so hard on Italy right now, is because they're in the same position that Greece was, not quite as bad, but they're in a similar position as Greece was back in 2011. What's funny to me is that, and this isn't comical, it's just interesting, is that in 2011, the European Union was forcing our market here in the U.S. down. It was a horrible year in 2011. If we go back and look at that chart, this is the drop in 2011. Earlier in the year, we saw peak earnings, which wasn't too crazy. That was in May. April, the government literally got shut down in April because they hadn't passed the bill yet to be able to keep the government open and funded. And we still had a positive month in the stock market. But then we began to see peak earnings, and then here's what happened. The U.S. Or the debt crisis in Greece hit us in August, and then late in August, the S&P Dow Jones Group, or folks that is a rating agency, that version of the S&P, they downgraded U.S. debt from AAA rated bonds to AA+. And we had major carnage in the market. In fact, it was worse than we saw this last October. And then in September, when they got everything kind of figured out, Greece got figured out in September, the debt crisis didn't turn out to be so bad here in the U.S., everything looked pretty good. We had a massive October, and then November was kind of crazy, but then October or December, we were positive. And for the year in 2011, this was over a 20% swing from top to bottom in the market between May and August and September. But by the end of the year, the market still ended up with a positive return by the end of the year. That's crazy, because we can have a pretty large swing from top to bottom and still end up okay, which means what we see now, this is up to today, this is today right here, November, that means that we could recover from this potentially by the end of the year if we have two really strong months. So that's a possibility. I'm not saying it will happen, but I'm saying it could happen if we can get those headwinds solved. China's trade war, the Italy debt crisis, and Brexit. Those three things, if we can get those things solved, we're not going to have a whole lot more headwinds to keep this market from revaluing back up to where we were in September. So that would be really nice. I know that you as well as I would probably be really happy with that. So what does this market look like, and what do we expect the turnaround to be? I'm going to take you back to 2010. In May of 2010, we had a massive drop. Again, about the same distance that we saw drop in October of this year. We just about saw that in May. It wasn't quite as bad in May of 2010. But then we had another poor month in June. a decent month in July, a poor month in August, and by September, this is just 4 months after this really bad month here in May, by September we were back in growth mode. In October, we had recovered everything that was lost. So within about 4 or 5 months, we were able to see a real comeback in the market. It was pretty short-lived, and the losses were pretty short-lived in the grand scheme of things. And patient investors that were able to stick through that were able to come out on top, and we had a very positive month or very positive year after that in 2010. So what I'm seeing from this right now and how we're going to be playing this, even though our traffic lights are showing a yellow light here, we actually did get a yellow light. I'm going to show you one of the positions we actually have. SPYG in your portfolios that you have with us now. We're seeing a yellow light on SPYG right now. It's official. It closed the month on a yellow. That means that normally we would take out about 25% of that position and put it into something else that's got a green light. But trouble is there's nothing else that's green lighting right now. Small caps, international, emerging markets, other large cap funds, everywhere across the board experience this downturn, and pretty much every asset class we're looking at is either in a yellow light or a red light red light territory. So there's no safe place to have been this last month, and our traffic lights only officially trigger at the end of the month. Sometimes we'll take some action sooner than that if we see some real issues coming along, but we just didn't see those this month, believe it or not. So in my opinion, I really think as an investor, we got to stick this one out. Even though this month we may not have seen the worst of it yet, we could still have a negative month this month, but within 3 or 4 months, just because of where we are in the market cycle, I truly believe that this is going to be a short-lived problem, and we're going to come back out of this here in 4 or 5 months from now and be have a market that's valued higher than where we were in September. So with that being said, that's pretty much all I have for today. I just wanted to let you guys know that we're on top of this. We're looking at it on a daily basis. We're keeping our ear pretty close to the ground on the news that's happening with the market. And we just don't see enough of a concern or worry to get out at this point. Even though we've had a big month, there's just not enough market-based data to support a much longer-term downtrend, even though this month we could see some more negative movement. I genuinely believe that we're going to see this thing turn around as we get the elections behind us and Brexit figured out and the Italy debt crisis figured out, because that's exactly what happened in 2011. It's exactly what happened in 2010. Once those things got ironed out, we moved right back along with the market, and it was growth as usual. So had we gotten out, we would have gotten out on false warnings with the traffic lights. And those are known to happen. There's no such thing as a perfect investment management strategy. Even buying and holding for forever is not perfect, because you're going to have 50% downturns in the middle of that. So we want to avoid the recessions, and right now we're just not seeing one. So with that, have a great month. We're going to see you again this next month, and I'll try to do these videos a lot more frequently. Thanks a lot. We'll see you later. Cheers.